Thank you very much, Oliver, for the kind introduction and the invitation to speak. So I'll give you a quick 15-minute whirlwind tour of our global investment outlook and the macro dynamics that underpin it. So importantly, we think this is the time to turn more pro-risk by adding equities to our existing overweight in credit. This is particularly true on the strategic horizon, so the medium-term outlook. And this is because the expected broad rollout of effective vaccines increases our conviction that we are going to build a bridge towards a broader economic restart over the course of 2021. And that also means that the cumulative shortfall in economic activity, which we think is a key driver for market valuations, will be limited to just a fraction of what we saw in the wake of the global financial crisis. And it is possible that a pro-risk view is now becoming quite quickly the consensus view within the market, both on the tactical as well as the strategic horizon. But our other investment views are likely to be more out of consensus. And so let me start by stressing that what we are going through at the moment is not a traditional business cycle. And that is important in how we speak about the current economic situation, how we understand its drivers, and the investment conclusions that we draw from it. So we had a situation in 2020 where activity was deliberately being stopped in order to address a global health crisis. So as a result, this is not a recession. And what we're currently experiencing is also not a recovery, it's an activity restart. So the way to think about it should be the framework of a natural catastrophe that typically allows for a very quick recovery back to pre-crisis levels as well as pre-crisis trends. And so, so that's our call, that we are going to see the high water mark in terms of economic activity in the course of 2021, and that this is not a replay of the global financial crisis. This is also something I think that financial markets understood very quickly in the spring of this year. But even though there will be this activity restart, it will be uneven, in particular at the sector level, in some cases also at the country level. So this is not a broad-based cyclical recovery. Instead, there will be differentiated performance between sectors, potentially between countries, and also between individual corporates. Because we, on top of the rebound that we're seeing as the virus dynamics are getting more effectively controlled and as the vaccines are being rolled out, is also that we see a number of structural trends, or in fact, I think we should call them transformation, being turbocharged by COVID-19. So we are looking at a phase of accelerated structural change, and that will imply a differentiated sector performance along the different dimensions that are being accelerated. So this would include a strong tailwind for sustainability. We were going to discuss this today in a bit more detail in one of the subsequent sessions. It means that we are going to see further digitalization which should support the tech sector. We of course see healthcare being front and center of a lot of considerations at the moment. And so this is really a very important factor that you instead of seeing a broad-based cyclical recovery, we actually will see a lot of differentiation. And from a macroeconomic point of view, I should maybe also add that one of the unusual features of this economic restart is that it's likely to be led by the service sector, especially contact-intense services, and not the usual recovery in manufacturing that sort of drives a standard recovery. The second important out of consensus view that we are holding is that we are likely to see over the medium term higher inflation than we have seen in the past, but unusually we will not see nominal interest rates, nominal government bond yields responding to that and rise materially. This sort of combination of higher inflation pressures, but still low interest rates, is what we coined the new nominal. And the reasoning behind this is that we have seen a policy revolution in the course of 2021, which much closer coordination between monetary and fiscal authorities. And we're seeing central banks globally, led by the Federal Reserve, changing their policy frameworks. And this will be really become important over the medium term, because currently markets are not fully appreciating the potential for higher inflation. And instead, we think there are a number of factors that will cause some cost pressures to become visible over the next couple of years. And in combination with central banks that are deliberately more inflation tolerant and whose hands might be tied somewhat more than in the past due to the sharp increase in public debt levels and the need to closely coordinate with fiscal authorities, means that not only inflation can rise, but that this increase is not going to be fully reflected in nominal bond yields. And the combination of continued greater reliance on fiscal policy measures than we have seen for a really long time, and noting that in many places, in many developed markets, we see bond yields currently quite close to the lower effective bound, especially at the very short end. This means that investors need to rethink carefully the role of government bonds in their strategic portfolios. And instead of investing in nominal government bonds, we would actually express a preference for inflation-protected securities, because contrary to past inflation episodes, we see nominal bond yields responding less, which means also that inflation is actually not bad, could actually be good for risk assets over a strategic horizon. And just to stress that this is not a near-term call that we're making for the next year, but it's something that we expect to play out over a 5-year horizon, 5 to 10-year horizon. But given that the markets are currently not pricing in any inflation, meaningful inflation pressure, and instead are convinced that central banks won't even deliver on their inflation targets, we think it's something that investors need to act on now while they still can, before markets are starting to price this in. And then the third key plank to our 2021 outlook is what's happening with the global economy. And instead of sort of coining it deglobalization, as many commentators, economists, market participants do, we actually like to look at it as globalization being rewired. And this is a reflection of the fact that COVID-19 has accelerated a number of geopolitical trends that we have seen already for several years. They effectively boil down to the global economic order increasingly becoming bipolar, with the United States on one end and China on the other. And despite a change in the US administration, we don't expect this to go away anytime soon, because at the heart of this bipolar order is a intense tech competition between the United States and China, and that is here to stay. From an investment point of view, the polarization of the global economy means that one needs to think very carefully about seeking country diversification in a deliberate way. We would recommend looking at China in this context, both on a tactical horizon as well as a strategic horizon. So these three factors together sort of make what we think is going to be recognized as a new investment order. So it's the turbocharged transformations that will create a lot of opportunities for investors at the sector level. And that's really where to look, instead of just looking at the economic restart and mistaking it for recovery. Secondly, the new nominal, which means higher inflation pressures, but no material increase in government bond yields that would compensate investors for that inflation risk. And then the third element of the new investment order, the rewiring of the global economy, in particular global supply chains. And that last part is also what is likely to provide the spark for the inflation pressures to come back. Because coming out of COVID-19, we're likely to see rising inflation pressures or cost pressures on a number of fronts. Health, safety, and regulation. We will see companies rethinking their global value chains, moving away from the least cost one to one that is more resilient. In order to be able to produce and to service clients in a range of different scenarios, and not being accidentally stopped out by some disruptions in supply chains. We also see increasing market concentration, giving dominant companies a lot of pricing power, market power, which they could decide to exercise. And then we think that with the political pendulum swinging against immigration in many places, and at the same time recognizing more explicitly than before social problems such as inequality, we could also see more support for wage increases, especially at the lower end of the income scale. So the outlook for 2021 is a positive one, because the early results of the vaccine trials give us greater confidence that we are going to see a full economic restart in the course of next year. Yes, we're seeing some challenging news in the near term, given the still elevated virus infection rates. But we think that very quickly now, with the vaccine being rolled out, that this is going to give a way to sort of a broader economic restart. And the crucial aspect of the availability of the vaccines is also that we are now more confident as investors, as companies, as households, and as policymakers, that we are actually building a bridge to the post-COVID world. And that will help to anchor medium-term expectations about incomes, about sales, about sort of market fundamentals, which will make it easier to pull through this last dip in economic activity in what the restart. And interestingly, the fact that the vaccines are available and that we're solving for, we're knowing, we have better visibility of the other side of this, the chasm we need to cross, also strengthens the argument for further policy support, because I think policymakers, whether fiscal or monetary, can be assured that they are just providing some short-term support and will eventually, at some point, be able to stop doing that. But additional policy support is essential to prevent broader scarring of productive capacities. We think that that is possible and plausible, probable, and as a result, think that contrary to the global financial crisis, which basically saw the initial shock propagating into a decade-long deleveraging cycle, which dragged down potential output growth, GDP growth, we're not going to see a replay of this long-term impact at this juncture. Instead, we think it is possible for economies to return to their pre-COVID trends from a macroeconomic point of view, in terms of the overall economic growth rates, the overall economic trends, but the economies will look different in terms of their structure, in terms of their composition at the time that we get there. And with that, let me thank you for your attention and turn it back to Oliver.